Hi everyone, Mark Lichtenfeld here, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. You know, earnings season is underway and you should be paying attention. Why? Because there are few expected catalysts that can move a stock like earnings can. And I say expected because certainly there are other catalysts like a company being acquired that can shoot a stock higher, but you generally don't know when those are going to happen. With earnings, you do know exactly when the results will come out because the companies announce the date ahead of time. So for example, earlier this week, Logitech International blew past earnings expectations for the third quarter, and the stock had a one-day gain of 16%. And a company doesn't even have to make gobs of money in order to see its stock soar. On Wednesday, Snap, the owner of Snapchat, that stock took off, leaping 28% in one day on better than expected earnings report. Now, how much money did it make? A shiny penny per share. But Wall Street had expected a loss of 5 cents, so that 6 cents difference pushed the stock through the roof. Now, in the third quarter, S&P 500 earnings are expected to decline 21%, so expectations are quite low. And as far as short-term stock moves are concerned, it's not how much money a company makes, it's how much money Wall Street thinks it's going to make. If a company comes in ahead of those expectations, the stock price can take off. And since expectations are low because of the pandemic, that gives a lot of companies the opportunity to exceed those expectations. Now, I trade these earnings reports, and I get into stocks ahead of their earnings releases and sell them after they've popped higher. And one of the key things that I look for is a company's past history of beating expectations. Now, it's certainly no guarantee, but a company that consistently beats expectations has a management team that knows how to play the Wall Street game, which is all about beating Wall Street estimates. So for example, Snap, which I told you about, gained 28% in one day on Wednesday, has beaten expectations in 7 of the past 8 quarters with an average price gain of 18% in the trading session immediately after those earnings results are posted. Logitech has exceeded Wall Street's earnings estimates in each of the past 9 quarters and averages an 8% gain immediately after. So those kinds of impressive streaks are something I strongly consider when looking for earnings plays. For your long-term investments, it's really not that important if a company beats estimates by a nickel per share. I mean, sure, we want earnings to be strong and we want them to grow, but it really doesn't matter much on a quarter-by-quarter basis if it's beating Wall Street estimates if you're planning on holding for the long term. But for short-term trading, those earnings beats can be gold mines, and you should learn how to play them or at least know what to look for. Now, if you want to know more about earnings and how to play them for big profits this earnings season, be sure to check out my free webinar by clicking on the link below. I'll see you next week on State of the Market. I'm Mark Lichtenfeld. Thanks for watching.